Okay, so this is for the subject capital markets, and the topic for this specific video is risk, concept of risk. So we have here an article from investopedia.com. Okay, so by definition, risk in financial terms is the chance that an outcome or investment's actual gains will differ from an expected outcome or return. Okay, so when we make investments, when we put money into something, an investment, a business, shares of stocks, or bonds, we have this expectation that we're going to get a certain amount of return from it. Okay, but again, since these are investments, these are businesses tied with businesses or involved in actual businesses. So there's the possibility that the expected return would not be equal to the actual return that we're actually going to get. So there are factors involved. So of course we have that, actual economic situation. The pandemic was unexpected and what do you call that, affected many types of businesses in a negative way. And so investments in those types of in those industries are in the negative, have resulted to losses, and on the part of the investors, since they took on the risk of investing in those industries, then they also suffered the losses. Okay, and so if we're going to simplify the definition of risk, it would be the possibility or the probability of losing your money or suffering losses. Okay, but essentially, it's the difference between the actual outcome and the expected outcome. Okay. Risk includes the possibility of losing some or all of an original investment. Okay. Quantifiably, risk is usually assessed by considering historical behaviors and outcomes. All right. Normally, for established businesses, if you want to make informed decisions before you invest in a particular company, sometimes you would want to look at their historical performance, financial performance. Are they profitable in the last 5 years or in the last decade? How have they been performing? Are they always profitable, or are there years that they resulted in losses, their operations resulted in losses, or are they consistently earning a certain percentage of profit, okay, based on their sales or revenue? Sometimes, you're more inclined to invest in businesses that have a track record or a consistent record of profit, okay? So in a way, you're assured of their profitability. But again, unexpected cases or some extreme cases could derail or could result to a different scenario. Okay. I just like to go back to this one. Losing some or all of an original investment. So let's say you invested in a business. Okay. You're not the owner. Oh, not this. Okay. Investment could take the form of equity. So in that case, you are part owner of the business. Or it could also take the form of debt or liability. In that case, you are a creditor of the business. Okay. So let's say this company is a corporation and you invested in a company in such that you are holding stocks. Okay. So you're a shareholder of this company. Now, if this company performs well and reported profits, and then they declare dividends, so the dividends will be distributed to the owners. And if you are an owner of that business, shareholder, then you would also receive a share of that dividends. Okay, so that's the return. But let's say this business incurred losses. Okay, you're not actually going to, receive negative earnings, but the value of your investment holdings would go down. Okay, if it's tied to the market price of the business, let's say during before the year January 1, 2021, for example, the market price of the business is 100 pesos, okay, per share. 100 pesos per share. And then at the end of the year, because they have operated for 1 year and then they reported losses instead of profit, then it's possible that the market price of their shares has gone down, let's say from 100 to 85 pesos, okay? So the valuation of your investment has gone down from 100 pesos. Let's say you invested at the start of the year and bought the shares at 100 pesos per share. At the end of the year, it's now valued at only 85 pesos per share, okay? You hasn't, of course, you didn't receive anything because it's negative, it's their suffered losses. So what happens is the valuation of your investment would be depreciated or would decrease, okay? And then that would be about, losing some of your investment. But here's the case. If this business has been greatly affected by the pandemic, for example, and they were forced to, during the first few months of the lockdown, they've only temporarily ceased their operations, but then, over time, it has affected them greatly negatively, and after a while, they've decided to, just give up, and they closed the business. So in that sense, shutdown of operations, there's a possibility of losing all your investment. Because in that case, they're essentially bankrupt already, so they probably don't have enough money to continue operating, and they just can't continue anymore. And even if they have assets still on hand, they have to pay off first the creditors before the owner. So in that sense, yes, you could lose all of your investment. But normally, only in that case, the business that you invested in shuts down, okay, or stops operating, all right? Moving forward to the article, in finance, standard deviation is the common metric associated with risk. Standard deviation provides a measure of the volatility of asset prices in comparison to their historical averages in a given time frame. Okay, so standard deviation, you can use this by collecting the information about the asset prices. If it's a stock, okay, then you can probably use this in, the ending market price of the stock for, the last 5 years or the last 10 years, right? Or you could also use this with the reported earnings of the company as a percentage of the sales or revenue. So you can see over time, let's say, in the last year, it's 12% net income, as compared to sales or revenue. And then the previous year, it's 10%. The year following that is, let's say, 14%. And then before that, let's say it's only at 8%. And then the year before that, let's say 11%. Okay. So with standard deviation, you're going to measure the volatility or the fluctuation between the figures that you've collected over time. But of course, the more, the merrier. Okay, the more, the more figures that you have, it's going to be more reliable in a sense because you have more information available, okay, used as a basis, okay? But you can use it for, the returns. You can also use it for the asset prices or the market price, ending market price. And then you can also use it in, let's say, the total sales of the company. How much is the deviation from year to year, okay? So deviation, okay, the difference from each other, essentially, okay? But there are other types of it. You can use it in other figures or items as well. There is a link, in the ERC tutorials V2, teachable.com. I have there a course on statistics for research, and there's, a discussion on standard deviation. So if you would please go over that portion, okay? The standard deviation is much more explained there, okay? Overall, it is possible and prudent to manage investing risk by understanding the basics of risk and how it is measured. Learning the risks that can apply to different scenarios and some of the ways to manage them holistically will help all types of investors and business managers to avoid unnecessary and costly losses. Okay, so you have risk, and then there's the acceptable level of risk, okay? At the acceptable level of risk, it's essentially your limit, okay? up to this point, okay, I'm still going ahead with the investment, but beyond the acceptable level of risk, you'd be like, no, thanks. I'd rather not, risk it. I'd rather not have that huge possibility of losing my money. Okay, so everyone, depending on the type of investor you are, conservative, moderate, or aggressive, so we have a certain level of risk that we are able to, accept. Okay, but that's what we call a risk appetite. Okay, actually, when I took the assessment, I am a conservative type of investor, but then I have investments that are moderate. I also have investments that are aggressive. Okay. Alright, so the basics of risk. Everyone is exposed to some type of risk every day. It's not just, business, not just investments. Let's say, whether it's from driving, and it can be an accident. Walking down the street, yes, you can also met with accident by, just walking outside. What do you call that? In getting infected by COVID because you're not, protecting yourself properly. In investing, you can, choose investments that did not do well. Capital planning, you realize that what you bought is, that not the best of its kind because of technological advancement. More or better, capital expenditures, equipments, machineries are already available in the market, okay? Or something else. An investor's personality, lifestyle, and age are some of the top factors to consider for individual investment management and risk purposes. Okay. Another thing is that the amount of money that you would invest, it should be something that you would not need in the long term or even in the short term, and it should be something that you can let go, or you would not be suffering much if you, lose all of it. Okay. So there is that. Okay. But, normally you're conservative if you cannot stomach losing your money, You're aggressive if you have that mindset that, yeah, it's okay. I know investment is risky. It's essentially a gamble sometimes, if you don't study beforehand and you just make your investments based on guts or whims, then yes, it's like gambling essentially. Okay. Each investor has a unique risk profile that determines their willingness and ability to withstand risk. In general, as investment risks arise, investors expect higher returns to compensate for taking those risks. Okay. So again, we have that adage, the riskier investments could provide you with higher returns, right? I'm not sure if you've already had your risk profile, but if you're a Gcash user, you could go to the tab G Invest, I think, and then they have the assessment there so that you would know if you are conservative, moderate, or aggressive investor. Okay. Investment risk arise. Investors expect higher returns to compensate for taking those risks. Fundamental idea in finance is the relationship between risk and return. The greater the amount of risk an investor is willing to take, the greater the potential return. Okay? Risk can come in various ways, and investors need to be compensated for taking on additional risk. For example, U.S. Treasury bond is considered one of the safest investments. So since it's a safe investment, it has low risk. And so the percentage of interest rate earnings there is actually low as well. And when compared to a corporate bond, because a corporate bond is normally private company, right? Whereas Treasury bond issued by the government is backed by the government. And we know that government is funded by tax revenue. So is there essentially, going strong. But compared to a private company which gets its funds from its owners, private individuals or private entities, it's not that sure, compared to government issued securities, whether they're going to succeed or not. Okay. So in this sense, the government issued securities provides lower rates of return because they're less risky. Okay, they're relatively safe. You are assured that you're going to get the returns. Okay, compared to a corporate bond. A corporation is much more likely to go bankrupt than the U.S. government, although as we've seen in the movie Default about the 1997 financial crisis in South Korea, banks can go bankrupt. Sorry, countries can go bankrupt, but of course a possibility that is very low, very rare, but it happens. Just know that it happens. Because the default risk of investing in a corporate bond is higher, investors are offered a higher rate of return. Normally, government bonds average is 4% annual return. But for corporate bonds, they offer 8%, 10%, and as much as 12%. Okay? Since it's much higher, so some investors would rather invest in corporate bonds rather than the government bonds. Okay, but for again conservative types of investors, then they would be fine with the government bonds because they're very safe. But for aggressive types of investors or moderate types of investors, they could probably stomach investing in corporate bonds instead. Okay, because the rates are higher. Quantifiably, risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Okay, I think we've read this earlier. Standard deviation provides a measure of volatility or fluctuation of a value in comparison to its historical average. So in a way, as I've said earlier, the more information you have to base it on or to measure the deviation from, then the better. A high standard deviation indicates a lot of value volatility and therefore a high degree of risk. Okay, a high standard deviation, the deviation is high in such that the difference from one response to another is, what do you call that, away from each other, or the distance is more. Okay, high standard deviation. Of course, low standard deviation, it means that the difference between the responses is much lower. Okay, low standard deviation. Okay, therefore lower risk. Then individuals, financial advisors, and companies can all develop risk management strategies to help manage risk associated with their investments and business activities. And as we've mentioned in monetary policy and central banking, banks are required by the BSP, by the regulatory agency, to have that portion, risk management, in their plans, reports to be submitted to the regulatory agency. Okay? Academically, there are several theories, metrics, and strategies that have been identified to measure, analyze, and manage risk. Some of these include standard deviation, beta, value at risk, VAR, and the capital asset pricing model, CAPM. Measuring and quantifying risk often allows investors, traders, and business managers to hedge some risk away by using various strategies, including diversification and derivative positions. Okay. Normally, by using diversified portfolio, you invest in not just one company but in many companies in various industries. Then you can lower the risk. Okay, and then derivative positions. Example is futures contracts or options contracts. Okay, forward contracts as well. Key takeaways: risk takes on many forms, but is broadly categorized as the chance an outcome or investment's actual gain will differ from the expected outcome or return. So, actual versus expectation. Risk includes the possibility of losing some or all of your investment. And then there are several types of risk and several ways to quantify risk for analytical assessments. We'll go over some of them a bit later. Risk can be reduced using diversification and hedging strategies. Okay. Riskless securities. While it is true that no investment is fully free of all possible risks, certain securities have so little practical risk that they are considered risk-free or riskless. Okay. Government bonds, normally they're considered riskless. Sorry, riskless. Okay, because it's pretty much assured that they would be honored. Okay. Riskless securities often form a baseline for analyzing and measuring risk. So these types of investments offer an expected rate of return with very little or no risk. Oftentimes, all types of investors will look to these securities for preserving emergency savings or for holding assets that need to be immediately accessible. So if you're an investor actually and you have a diversified portfolio, of course some of your investments would be put into riskless securities. Okay. Examples of riskless investments is securities, certificates of deposit, government money market accounts, U.S. Treasury bills, or government bonds. The 30-day Treasury bills is generally viewed as the baseline. So, for one, it is issued by the government, so the issuer is very much safe. And then for two, it's short term. So after 30 days, you can already redeem the principal amount that you invested as well as the return that was promised to you. Okay. So the thing is, it would depend on the issuer. If it's issued by the government, it's relatively safe. If it's issued by a private corporation, it's much riskier compared to government-issued securities. And then the shorter the term, the lower the risk, because you only have that much time to wait before you can, redeem the principal and the interest, right? But if you compare it to, long-term securities, you have to wait that much amount of time, and there are a lot of things that could happen within that time period, right? 5 years, 10 years, 20 years, and then there are century bonds, right? So a lot of things could happen there. There's a possibility that the issuer could, go bankrupt. They would have financial troubles. Almost every century there are how many financial crises that would occur. So the longer the term, the higher the risk. So the baseline that they have here for riskless investments, government treasury bill, and then shortest term is 30 days. Okay. It is backed by the full faith and credit of the U.S. government, and given its relatively short maturity date, has minimal interest rate exposure. Risk and time horizons. Time horizon and liquidity of investments is often a key factor influencing risk assessment and risk management. If an investor needs funds to be immediately accessible, they are less likely to invest in high-risk investments or investments that cannot be immediately liquidated, and more likely to place their money in riskless securities. Time horizons will also be an important factor for individual investment portfolios. Younger investors with longer time horizons, you have, more years ahead of you before you retire, more years ahead of you for you to work and put money aside for investments, may be willing to invest in higher risk investments with higher potential returns. Older investors would have a different risk tolerance, because they would be needing the money sooner, let's say 5 or 10 years, since they will need funds to be more readily available, right? I'm going to skip this. We don't have this in the Philippines. Types of financial risk. Every saving and investment action involves different risks and returns. In general, financial theory classifies investment risk affecting asset values into two categories. We have systematic risk and unsystematic risk. So broadly speaking, investors are exposed to both of these risks, again, systematic and unsystematic. So to differentiate the two, systematic risk, known as market risk, risks that can affect an entire economic market overall or a large percentage of the total market. So it has nothing to do with your industry, it has nothing to do with your product. It's a situation that affects all. Example, the pandemic. Okay. It's affecting everyone, although there are still industries that thrive in it, right? Market risk is the risk of losing investments due to factors such as political risk, macroeconomic risk, that affect the performance of the overall market. Market risk cannot be easily mitigated or reduced or eliminated through portfolio diversification. Other common types of systematic risk can include interest rate risk, inflation risk, currency risk, liquidity risk, country risk, and social-political risk. On the other hand, unsystematic risk, also known as specific risk or idiosyncratic risk, is a category of risk that only affects a certain industry or a particular company. Unsystematic risk is the risk of losing an investment due to company or industry-related or industry-specific hazard. Examples: change in management, product recall, regulatory change that could drive down the company's sales, new competitor in the marketplace with the potential to take away market share from a company. Investors often use diversification to manage unsystematic risk by investing in a variety of assets. Okay. In addition to the broad systematic and unsystematic risk, there are several specific types of risk. We'll go over them. Business risk. Viability of a business. The question of whether a company will be able to make sufficient sales and generate sufficient revenues to cover the operational expenses and turn a profit. So essentially, profitability is being questioned here. While financial risk is concerned with the cost of financing, funding of the business, business risk is concerned with all the other expenses a business must cover to remain operational and functioning. So it has more to do with operation results. So statement of financial performance really would be your basis here. These expenses include salaries, production costs, facility rent, office, administrative expenses. The level of a company's business risk is influenced by factors such as cost of goods, profit margins, competition, overall level of demand for the products or service that it sells. So essentially operations. Okay. Credit or default risk, the risk that a borrower will be unable to pay the contractual interest or principal on its debt obligation. So this type of risk is particularly concerning to investors who hold bonds in their portfolios. If they cannot collect the money, then that's a bad thing. Government bonds, especially those issued by the federal government, have the least amount of default risk, and as such, the lowest returns. Corporate bonds, on the other hand, tend to have the highest amount of default risk, but also the higher interest rates. Bonds with lower chance of default are considered investment grade. Corporations that are very much established, they have a long history, and there is some sort of analysis that they could withstand any economic situation, then in a way they are somehow considered just as riskless as the government bonds, okay, if they have that proven track record, right? But for new companies without much history, questionable, because there are years that they are turning a profit, there are other years that they're suffering losses, so inconsistent with their performance. So that's a bit questionable and quite risky. All right. While bonds with higher chances are considered high yield or junk bonds, high chances of defaulting, okay, or being unable to repay the investment and the interest rate on them. Investors can use bond rating agencies such as Standard & Poor's, Fitch and Moody's to determine which bonds are investment grade and which are junk. Okay, I'm not sure if we have this in the Philippines, right? But these rating agencies, they do rate U.S. companies which are normally operating internationally, and they also provide ratings for countries, credit ratings. Okay. Country risk refers to the risk that a country won't be able to honor its financial commitments. Countries, they have obligations, they borrow from international financial institutions, they also borrow from other countries, so there's a possibility that depending on the situation, there would be a possibility that they won't be honor the financial commitments. When a country defaults on its obligations, some sort of bankruptcy already, It can harm the performance of all other financial instruments in that country, not just the government, but all companies operating in that country would also be affected. Okay. As well as other countries, it has relations with. Country risk applies to stocks, bonds, mutual funds, options, and futures that are issued within a particular country. This type of risk is most often seen in emerging countries, emerging markets, or countries that have a severe deficit. Okay. Essentially, their equity is in the negative. That's what a deficit is. They have more borrowings or liabilities compared to assets, right? Foreign exchange risk. When investing in foreign countries, it's important to consider the fact that currency exchange rates can change the price of the asset as well. So depending on, the supply and demand for a particular currency, it could go up, it could go down, right? Foreign exchange risk or exchange rate risk applies to all financial instruments that are in a currency other than your domestic currency. So if you're a Filipino investor, you have investments in other countries, so you have to translate your investments into the functional currency, Philippine peso, at the end of each year to see if you are earning or not. Okay. As an example, if you live in the US and invest in a Canadian stock in Canadian dollars, even if the share value appreciates, you may lose money if the Canadian dollar depreciates in relation to the US dollar. Okay. But of course, those are unrealized gains or losses. If you hold on to the security, then you might be good, just wait for it to go up again before you sell it so that you could realize the gain. Okay. Interest rate risk, the risk that an investment's value will change due to a change in the absolute level of interest rates. The spread between two rates in the shape of the yield curve and in any other interest rate relationship. This type of risk affects the value of bonds more directly than stocks and is a significant risk to all bondholders. Okay. In terms of bonds, yes, they do offer interest rates, but again, interest rates are being regulated. If there is a change in the prevailing market interest, then it could also change, the ones imposed on bonds. But as for stocks are, they only declare dividends when the company generates profit. But if they don't, then they're not actually required to declare dividends, and they can only declare dividends up to the amount of profit that they have for a particular year. Okay. Or their cumulative earnings. Okay, so whenever there's changes in interest rates, the return to the stockholders is not that affected much. Okay, unless they have investments in bonds as well that are affected by this. Okay, I want to pause for a bit because the neighbors' dogs are going a bit crazy. They're barking mad. Alright, continuing on, we have political risk. So this is the risk an investment's return could suffer because of political instability or changes in a country. For example, the situation in Myanmar a few months back, or the current situation in Israel and Gaza. Okay. So this type of risk can stem from a change in government, legislative bodies, other foreign policy makers, or military control, also known as geopolitical risk. The risk becomes more of a factor as an investment's time horizon gets longer. Okay. Counterparty risk, the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. Okay. Normally in a transaction there are two parties at least, but there could be three as well. You have your insurer or guarantor, or it could have a hedging instrument against a certain contract. Okay. Counterparty risk can exist in credit, investment, and trading transactions, especially for those occurring in over-the-counter markets. Financial investment products such as stocks, options, bonds, and derivatives carry counterparty risk. Okay. Liquidity risk associated with an investor's ability to transact their investment for cash, convertibility to cash. Typically, investors will require some premium for illiquid assets, which compensates them for holding securities over time that cannot be easily liquidated. Okay? Risk versus reward. So the risk-return trade-off is the balance between the desire for the lowest possible risk and the highest possible returns. Okay? When it comes to risk, you want them to be as low as possible. And when it comes to returns, you want it to be as high as possible. Okay? But you need to have a balance between them. In general, low levels of risk are associated with low potential returns, and high levels of risk are associated with high potential of returns. Each investor must decide how much risk they're willing to take or able to accept for a desired return. So this will be based on factors such as age, income, investment goals, liquidity needs, time horizon, personality. Okay? The following chart shows a visual representation of the risk-return trade-off for investing, where a higher standard deviation means higher level or risk, as well as a higher potential return. Okay, standard deviation, low risk, low return, high risk, high potential return. It's important to keep in mind that higher risk doesn't automatically equate to higher returns. Okay, for example, investment of $100,000, sorry, 100,000 pesos na lang. 100,000 pesos, and then there's a possibility that you will earn as much as 20,000 in that particular investment, right? So you could earn, okay, at the end of the year, maybe, your 100,000 could become 120,000. Okay, so there's a possibility of 20,000 return. Okay, but it's not, there is as high, with that high return, there is a corresponding high risk. Okay, so there's a possibility that instead of earning 20,000 pesos return, there's a possibility that you would actually, let's say, lose up to 20,000 as well. Okay, so instead of your 100,000 becoming 120,000, it could become 80,000 only. Okay, so essentially the risk or the possibility of return would be equivalent to the possibility of loss in a high risk situation. Okay, so again, high risk does not equate to actual return, but only the possibility of getting a high return. Okay, if everything is ideal, the economic situation is good, everything else is doing well, then there's a possibility of that much returns. Okay, but if things don't go that way, if there are problems in the market, in the economy, then there's still a possibility of a loss. The risk-return trade-off only indicates that higher risk investments have the possibility of higher returns, the operative word being possibility. But there are no guarantees. On the lower risk side of the spectrum is the risk-free rate of return, the theoretical rate of return of an investment with zero risk. It represents the interest you would expect from an absolutely risk-free investment over a specific period of time. In theory, the risk-free rate of return is the minimum return you would expect for any investment because you wouldn't accept additional risk unless the potential rate of return is greater than the risk-free rate. Okay. Normally for conservative investors, you have that minimum return that you want to get for your investment. You would not agree to just giving away your money, putting it into a business or an investment and not getting any. Okay, so you need to have that minimum return for the lowest amount of risk as well. Okay, and then for any additional risk that attached to the investment, then you would demand for a higher rate of return corresponding to that additional risk that you would possibly be willing to take on. Okay, Risk and diversification. The most basic and effective strategy for minimizing risk is diversification. Putting your money into, a lot of things. You have your short-term investments, you have your long-term investments. You don't put it in just one company. You put it into different companies across different industries. Okay. While most investments, where are we? Diversification is based heavily on the concepts of correlation and risk. A well-diversified portfolio will consist of different types of securities from diverse industries that have varying degrees of risk and correlation with each other's returns. While most investment professionals agree that diversification can't guarantee against a loss, again, it's still not a guarantee that, even if you diversify your investments, they could all react the same way in certain situations. For example, in time of war, no matter how much diversified your portfolios are, they would be affected the same way. Okay. It is the most important component to helping an investor reach long-range financial goals while minimizing risk. Several ways to plan for and ensure adequate diversification. Spread your portfolio among many different investment vehicles. So you can have your cash. Okay, don't put everything into illiquid investments. Okay, you have to consider liquidity as well, convertibility to cash. So you can have cash, stocks, bonds, mutual funds, ETFs, and other funds. And then look for assets whose returns haven't historically moved in the same direction and to the same degree. Okay, that way, if part of your portfolio is declining, the rest may still be growing. Okay, so for example, you have this company that over the years they have, profited or thrived, but they have also companies that haven't been doing well. Although, it kind of doesn't make sense sometimes how you're going to consider that, move and haven't historically moved in the same direction and to the same degree. Okay, so you're saying that some of the businesses would have been resulting in high profits, others are, not so much profits, but then when these companies are not doing well, these other companies are the ones doing well. Okay, alright, that's it. It doesn't necessarily mean that when one is profiting, the other is incurring losses. Okay, it's just that when this one is performing really high, let's say the returns are 20-30%, and you have other businesses during the same period only reporting, let's say, 5 to 8% of margin. But then, let's say 5 years later, you see that these companies on this side, they are the ones performing low, let's say the 8 to 10%, and then these other companies are the ones performing high, let's say 15 to 20%. Okay, so that in a way that's the inverse correlation. Okay, so that regardless of the situation, you have performing investments, and then you have high and low performing investments that would offset the effect of each other. Okay, so if in a particular situation you have high performing investments and low performing investments, that way if part of your portfolio is declining, the rest may still be growing. Okay, because if they're all in the same direction, let's say during a particular period, A, B, C, D, all of your investments are all doing well, right? And then another period, all of them are not doing well. So, in a way, that's not really diversification because everything is going in the same direction. So if the economy is doing well, then, you would be getting returns or high profits. But if the economy is not doing well, you would be suffering losses. So that's not exactly diversification, right? Excuse me. Stay diversified within each type of investment. Include securities that vary by sector, industry, region, and market capitalization. It's also a good idea to mix styles too, such as growth, income, and value. The same goes for bonds. Consider buying maturities and credit quality. So for bonds, you probably have, 90-day bonds, 180-day bonds, or 1-year bonds, 2-year bonds, things like that, right? Include securities that vary in risk. You're not restricted to picking only blue chip stocks. In fact, the opposite is true. Picking different investments with different rates of return will ensure that large gains offset losses in other areas. So keep in mind that portfolio diversification is not a one-time task. You should monitor it and then change the composition of your portfolio over time as you determine which stocks are performing, which ones are not. Okay? Which ones are not needed in your portfolio, which ones should you include, right? Make sure the portfolios have a risk level that's consistent with the financial strategy and goal that you've set. Bottom line, we all face risk every day, whether we're driving to work, surfing a 60-foot wave, investing, or managing a business. In the financial world, risk refers to the chance that investment's actual return will differ from what is expected. The possibility that investment won't do as well as you'd like, or that you'll end up losing money. Okay? The most effective way to manage investing risk is through regular risk assessment and diversification. Although diversification won't ensure gains or guarantee against losses, it does provide the potential to improve returns based on your goals and target level of risk. Finding the right balance between risk and return helps investors and business partners, managers, achieve their financial goals through investments that they can be most comfortable with. Again, depending on your risk appetite. Okay? So that's it for this one. We've discussed the concept of risk. Thanks and bye.